Thank you everyone for joining in. The webinar will begin shortly. Good afternoon to one and all present here. In today's webinar, we have with us our founder and CEO, Dr. would be to provide you with a learning experience and handhold you as a new investor. Towards the end, he would also be answering some of your questions. Over to you, Mr. Mohit.
Thanks a lot, Adrian. You should check your connection. I think your connection is breaking up. A very good afternoon to all of you. This is an interesting webinar session. We would be covering some of the events that has been transpiring around the world, basis which what is the kind of impact that we can see on the Indian economy, and basis which there's no point talking about just the broader economy and just the broader strategies unless we define a individual strategy of investing. So what should be your strategy in these times is the main theme of this presentation, and we would try to cover an answer to this in a very definable way. As I personally believe, and I always have told you that there are, when you go and try and predict what can happen, you're always akin to being right or wrong. But having said that, in between right or wrong, is there a middle way which can take care of both? And that is what I'm trying to achieve today in today's webinar, that what is it that we can do to make sure that we hedge ourselves to the current market environment, and how do we do that in a way that we can still manage to make money / save money during the current set of times. So with that logic, I will open the presentation. Before I go deeper into the presentation, you know that we are at our lowest price of the last 2 months now, which is 19,999 for 2 years. This offer will be closing soon. The advantage that you're getting is that the site prices are double of this, which is around 40,000. You're getting the same package of 40,000 in 19,999 for 2 years. This also includes all the items that I mentioned out here as free. One is the upcoming series of technical products, which are priced at around 20,000 per year. So if you take the 19,999 for 2 years, the technical product worth another 20,000 is free with this. Single advisory per page is what we are coming out with. That will be a free part of this. Mojo TV, as you guys, I had announced it last time onwards, the subscription to that would be free. All upcoming innovations will be free. And the biggest point is that you can still extend this multiple times, which means that you can buy this package 2 times, 3 times, 4 times, 5 times to make sure that you're extending it long time. And during that period, let's assume you've extended for say 8 years by buying it 4 times, because it's a 19,999 for 2 years. There will be no price hike for you. So anything that we do in the next 8 years will be a part of that particular package. So this extension that we are giving today, possibility will be not there sooner, but you still have a chance to extending it as much as you can. Point to note out here is that these extensions and this pricing of 19,999 is only available on this webinar. So Adrian will put in the link in case you want to subscribe. Please use that link. Don't try and go to the site and find out this link. This link is not available on the site. With that, let's get on to the presentation, because I think we have a very interesting set of presentation today. Simple things are often the most difficult to understand. And today I'm going to focus on some of the simple things, which is, I think, eye-opening as far as what I'm seeing in the markets that is going to happen, or that is currently happening as we are talking. Now, if you look at the current environment, there's a radical shift. There's a huge shift that has happened. I mean, there was around 10 years back when our reliance to FI investors was so high, in extent to around 40 to 50% of the market cap used to be moved by the movement of the FIs. And that was primarily the reason because the retail participation into equity markets was marginal at that point in time. Now, if you see what has happened in the last, say, 18 odd months, is that flux of new investors has come into the markets. Huge flux of new investors have come. Close to 45% of the market participation today. 45%. So I'm talking close to 50% of the market participation is from just the retail investors. That's a huge move for any country to be self-dependent on market movement, and as we call it, a little bit of unplugging or decoupling yourself from the international markets. That is something that you're seeing even in the returns of global markets as well as the Indian markets. I'm going to cover the global market returns and how the Indian markets are behaving during the same period of time. But there is a bit of a decoupling that is happening because we are becoming an economy where the market participation is moving from the external FI driven activities to internal retail participation, mutual funds and insurance companies participation. The numbers of new investors is astounding. I don't know how many of these investors will stay invested over a long period of time, but currently the numbers are astounding. I've taken a very minimal numbers, although the numbers are close to 20 lakh a month of new investors who are getting added into the equity markets. But having said that, even if you take 10 lakh, that's a huge number, that is getting added on. In terms of sheer percentage, you're talking about a 50 to 60% growth, incremental growth that is happening on the retail investors in the market. The third point is that the debt opportunities are becoming more and more tighter. The yields are becoming tighter. You guys know, what kind of short-term yields and the long-term yields that we are getting. So with the debt yields becoming tighter and the inflation clubbed with the increasing inflation, right? Debt will soon become a negative yield product. So even if you look at debt, I'm not just looking at long and short-term debt. Majority of our debt that investments that happen are in, either in fixed deposits or in government securities, or in PF, PPF, wherever you see, with a inflation rate that is on the rise, if you are parking your money in the debt instruments, it can become a negative yield product, especially on the fixed deposit side, and even on short-term debt instruments where the yields are getting crunched completely. So equity markets will become some of the sought out place where the investor would like to park their money if they have to earn anywhere in between a double digit return. They will have to make sure that the only resort that would be there over a long period of time would be equity. This tells you why is this slide important. It's because wherever we talk about even consumption, we talk about import export, we talk about exchange fluctuations in terms of currency rates, wherever the dependency is something that we keep making it in house, the impact of this is long term, and the impact of this becomes sustainable. Now, if you were to consider this as an industry, equity market investing as an industry, if you were to consider that, we are becoming more and more domestic consumers, right? We are becoming more and more consumption driven, but domestically, by having more influx of new investors that are coming into the market. The other thing that very interestingly is happening is that even the regulators like SEBI is making retail investor norms very tighter on things like margin requirements and all this stuff. So why is this I think this is one of the smartest combinations that I've seen over the last 30 years of my career, is that the regulator, the influx is coming in, but the regulator is drawing out the complete volatility of the market from this new influx that is coming in. So margin requirements are becoming very high, right? There is hardly any scope left, or the regulator is leaving with the retail investors to play the whole leverage game in the equity market space. So this means that what I perceive over a long period of time is that the volatility will get managed very well, because it is not just the trading fluctuation that will happen. Investors who are retail and who come in without leverage with very high margin requirements will be forced to take a more fundamental approach, will be forced to take not a technical approach, and that will result in a bit of a stability in the market in the longer run, and self-reliance and self-dependency in the longer run. Now, the prime objective is to ensure that not providing leverage to retail investors is to dissuade them from trading. Why would you dissuade the retail investors from trading? There are a number of reasons that the regulator has, right? The first reason is that these are new investors. They are not experienced investors. And if they come into the market and the first result of that is that they lose money, they will never, ever come back into the market, or they may take a long time to come back into the market. The second is the definition of retail per se. When retail investors come in, the regulator becomes very aware of what kind of safety nets it needs to put so that the retail doesn't lose money as much as the super HNIs, who are typically more akin to trading. They can take up the losses, but the retail cannot take those kind of losses. The cost of transactions are going down. Today you have, you talk to any broker, every broker has got a discount brokerage firm, or there are pure discount brokerage firms. So the cost of transaction is going down. Cost of doing business is going down when you talk about the equity markets. And this will propel a lot of investors to come into the market. But having said that, the only thing that I don't feel that is happening out there is the focus on advisory. Everybody is running to acquire new customers. Everybody is running to give them a platform to make sure that it is a low cost platform so they can transact. But the focus on advisory and education is missing, which is the most important thing for any retail customer who comes in new into the market, or even if who's there for a longer period in the market. Now, if you look at the current macros in India, right? Fundamentally, we are doing fine. I don't think so there is anything that is wrong with the economy at a fundamental level. When you look at the corporate results, when you look at the fundamental growth of companies, or when you look at the index companies, when you look at even the small cap and the mid caps and the micro caps, in terms of the sheer spread of their fundamental growth, there's a lot of deleveraging that is happening. There's a lot of growth that is happening, despite the fact that we've just come out of almost a year and a half closure because of COVID. but still the growth is intact. Now, when the growth is intact, that means that a part of your fundamentals are intact. A largest part of your fundamental is intact. A largest part of fundamental is also dependent on what kind of domestic reliance you have on your raw materials, on your sourcing cost, on your debt raising capabilities, and so on and so forth. The second most important point is that the revenue models will get checked, right? So there is something that I can see where either a fuel will come, a big fuel will come, or there is a big roadblock that will come, because in the history of the Indian stock market, this is the first time ever where the loss-making companies or companies that can't even see profits for a long time are raising money through IPOs and are staying there and are very transparent about it. I mean, if you read the prospectus of Paytm, which is coming out with an IPO, it clearly says that in the foreseeable future, they don't know how they will make money. So they do not know in the foreseeable future what is the profitability of the company going to look like. So this is a very radical thing. This is a very US thing. This is a very Western thing, that you are investing in companies that have a possibility at a maybe a multiple year level to make money and hence give the money back to the shareholders. But but if you see currently the set of companies that are coming out with IPO, apart from fundamentally some very strong companies, most of the companies are new age companies, and that will define whether India as a country will appreciate these opportunities of market share gathering companies rather than profitable companies. Because conventionally we have been a very conservative economy where we reward profits, we reward fundamentals, right? Whether we will accept companies at large which have a current fundamental degrowth in terms of their P&L, but having said that, they are in the prospect of gaining market share and at a certain point in time become profitable. So this is going to be a testing time, both as an investor for us as well as for these companies. I personally believe with the upcoming LIC IPO, government has no choice but to manage the overall sentiments of the market. So this is a big point, because this is my personal view that this is one of the big money collection event that will happen as far as the government is concerned, the LIC IPO. And I feel that obviously the government will not like to have an IPO in a market sentiment which is against the fundraising capability. So I think the market will hold its ground for a time period till the time at least the LIC IPO is out. I think the prospectus is getting filled in tomorrow, but there is a big chance that till the time the IPO is out, which is maybe another 6 odd months or maybe mid of next year, you may see a stability out there in the markets. The fourth point is pressure on inflation and interest rate. This is something which the government is really trying to control, but there is a big pressure on growing cost and also on which way to go on the interest rates, because both of these drive consumption. Both of these drive consumption, but not in line, or they can drive consumption on the different lines, and hence keeping a balance of lower inflation rates and control on interest rates is very important, which the government, I think, so far has been able to manage. But looking at how the economy is growing, I think it is almost certain that the inflation rates will need to go up. Now, fundamentals can, according to me, the last 1.5 years, the fundamentals can improve way better moving forward. Because see, what happens is that when you are in a straight 10-year open economy where you're doing your business, you're expanding, you're sometimes putting in cost for the sake of getting in revenues, and then suddenly this whole lockdown happens, right? It has made, and as a business owner, I can also tell you from my side, it makes you very cost conscious. So, and that cost consciousness is not something that you can give off very easily. So according to me, the profit margin growth will become better moving forward, primarily because there's a lot of cost consciousness that has come into the companies due to the events that we've seen over the last 1.5 years. And the last and the most important point is the increase in the broader participation, as I was talking about, which is investors coming in and picking up the domestic equity market, which has never happened over the last 20 years of our investing uh, history, or maybe 25, 30 years. I've never seen this, that the broader participation of the retail investors is creating a buoyancy in the markets. Now, what are my prime worries? I mean, forget crude, forget raw materials, forget Evergrande and all of that stuff that is happening. I think my prime worry is that China gave us a virus. I think it can give us the next financial crisis. Right? That is something that I see as my big worry, because to me, the China worry in terms of the sheer strength that they have on the market cap, which is a 10%, world market cap, global market cap, it can spread a spiral into the whole growth of the global economy if the financial troubles are not managed very well. It has also got a huge reservoir of US dollars. So there is a lot of effect that can happen that you and me can't perceive today if China was to take a U-turn, or if China was to go back. And the sad part is that you and me today sitting here, because there is no data, because the Chinese economy is so opaque in terms of disclosures, that you really don't know what kind of a risk are you playing out there. Right? You've seen Evergrande happen. You've seen the exposure. You've seen one payment default. You've seen one payment paid out. You've seen, a private equity investment happening at this stage to bail them out. So you're seeing a lot of things, but you really don't know what is happening inside. So according to me, China will be a big black hole till the time we have some good news coming out in terms of what is happening out there, or maybe some good news coming out in terms of their share market performance. But I think the opaqueness of China is something that really troubles me in terms of doing any kind of a broad analysis in terms of what can happen. You have the real estate issues growing, you have the internal debt issues growing, non-transparency, manufacturing issues, raw material price impact. There's a lot that can happen because of the way China is positioned as of today. Now, if you look at the performance, now this is very interesting. YTD returns, this is as of I think 18th of September. But YTD returns, if you see, India has done around 36.62. MSCI India has done 27. US has done around 19%. MSCI World has done around 16%. So we have been the country that has given the highest returns in this particular year at a YTD level, which is at around 36%. If you consider last 1 year, we are over 100%. So the growth has been phenomenal. The returns have been phenomenal. We are today sitting right at the top of the table where it is in terms of the YTD returns out there. But if you see the market cap, now you're talking about India at around number 6 when you look at the market cap in terms of $1 trillion. We are at around $3.4 trillion. US is sitting at around $50 trillion, and China is sitting at around $12 trillion. So now this is still shows you a lot of depth that India has to go through in terms of its future growth over the next 5 to 10 years. So whenever you look at the big investors coming and talking to you about how India can, how 50,000 index or 60,000 index can become 100,000 and so on and so forth. The prime data of their reference point is the market cap data in terms of the growth. And the other prime data is your market cap to GDP, which is around 130, which is very reasonable. If you see in the US, it is around 240, your market cap to GDP. China is 84. So there are some countries which are a lot of countries. If you see, 5 out of the 6 countries that we've got above us are typically on a higher market cap to GDP ratios. So there is a seemingly big amount of growth that can be perceived out here. If you look at the forwards, if you look at the PE forwards, India today at a 1 year forward PE is at around 25, right? Historicals have been at around 19, 20. We are at around 25. So there's clearly a 20% overvalue that we can see out here on a long-term average. But having said that, there are times that we've been higher than this, we've been lower than 19, but there is a 20%, mean diversion that you can see at a average level out there. US is at around 33, and rest, you got around 19, 18 range. So are these higher valuations? The answer is yes. These are definitely higher valuations. Are they the higher valuation that can correct itself by 30, 40%? As I said, I do not see that. I've said this before also. I don't see that happening as of right now. Now, this is a little bit of a broader touch and feel of what is happening across, right? So what do we do out of this? What is the strategy that ultimately it's good to hear, good to see new data points, but isse hame kya milega? What is it that we can do out of all of this? So according to me, there is a tug of war era that is going on. There is the pull this side, then this side, and this side, so there is, when you speak of a clear bull market, when you speak of a clear bear market, when you speak of a clear flat market, right? There are clear indicators, point to point, 30% down, point to point, 50% up, right? According to me, that is not what it is looking like. I think it will be a big amount of pull and push that will happen from both sides. So when I say a tug of war era, I typically mean that the market can go down 5-7%, then it can go up 5-7%. So it will be a big flow of positive, negative that will keep happening. It will not give you a clear indication that it is down clearly and it will be down for the next 1 year, or it is up clearly and it will be up for the next year. So according to me, this is a this is a term that I'm coining for the first time. It's a tug of war economy right now, or a tug of war market cycle that we are in. We are not in a, it will give you perception of bull market sometimes, it will give you perceptions of bear market, and it will give you perception of kuch nahi hua hai. If you see last 1 month also, right, with Evergrande happening, a lot of people said, okay, now it is the start, right? But when it came back, you also said, oh, it's very strong. So, it is this side. So there are corrections of 3-4%, there are corrections of positives of 3-4%, and that is what will keep happening in this whole dysphoria, because apart from the valuations which cannot be justified at this particular stage, the broader sense of economy which is still opening up and the growth that is there, which is fundamental out there, there are news points which are trying to get things down or things up. So there is inherent strength in the market which is stopping the market to go one way down, and the valuations on the other side is not letting the market today go on one way up. So there are both parameters which are working against each other, and this gap will be played by sentiments. So this tug of war, the larger impact of 5-7% here and 5-7% here is going to be a sentiment play. So for example, if there is a selling pressure that comes today on some event, it will go on as very drastic selling pressure for 2-3 days, and then it will recover very drastically in another week or maybe in 2 weeks time. So I see this kind of a behavior emerging out of the market. So what is the tug of war view? Apart from China impact, the markets, according to me, globally can swing both ways in a big time. Now, when I say big time, my suggestion of big time will be it can go 5-10-15%, it can go 5-10-15%, right? So it will sway like this, and that is the reason I'm calling this as a tug of war kind of a economy in that particular area. There is no imminent data. There is no imminent data at all suggesting a long drawn bear run. If there was anything, we would be the first ones to come to you and tell you that we are seeing this particular trend. We are not seeing any big data appearing from anywhere which is indicating a long drawn bear run, apart from the fact that if you were to keep the whole China equation out. In the global economy, otherwise, there is nothing that seems to be off to give a ring of bear run start. So that is something that is not there. Fundamentally, it's not there. And technically, it doesn't look like. So there's no indication at all of the market slowing down, barring the fact that the valuations are very high. And if the valuations are high, our perception is that it has to correct at some point or the other, which is something that is, overdue as a correction. The yo-yo bandwidth of this tug of war era can be in between 10-15%, right? So it can be 10-15% up, it can be 10-15% down. So it can be both ways. That is the whole thing. But I feel that the resilience of holding back beyond that, which is say 10-15%, is very high in the economy. The resilience of holding any drawdowns in the market, maybe in 5 years, and I'm not saying this 10-15% can happen at one time. You may have a 2-3% and then it will pull back. You may have a 4-5%, then it will pull back. So you will have a lot of resilience that the markets can show over a period of time. The other thing is that we have a large growth of service industry, right? A lot of today companies in India, majority of the companies are more getting focused towards the service side. Now, service side, apart from your currency impact, typically gets deterred or remains outside from the whole manufacturing impact of raw materials. And that is one of the reasons that we are seeing sectoral growths happening. We are seeing small service growth that is emerging out there. The whole story of a Paytm, the whole story of a Zomato is the whole service sector story. So there is a service sector play that can be a big play moving forward, even if we get into any kind of a manufacturing crunch. Now, is there a way to make money during the tug of war era? So what is the way in which we can make money during this whole tug of war era? So this is the two words that I always give you, and I will give you today as well, that there is only two things you need to do: is be patient and have the discipline. You cannot not have an impact on your portfolios. You cannot not have an impact on your investments, and you cannot sit out completely waiting for this to participate, because in the tug of war event, the thing that wins is stock selection. Is there right stocks at the right point in time that you can pick up? That drives the whole era of this movement here and there, right? So in that, having the patience, if you are a weak-hearted person who feels that a drawdown of maybe 1 month, 2 months can affect you, then I think you need to reconsider your participation in the equity market. But if you have the patience and if you have the discipline of what I'm going to tell you right now, then I think there is a lot of things that can be turned around as positives in any market scenario. Forget this particular market scenario. Now, if you look at the broader strategy, let's talk about the broader strategy. The broader strategy, the first thing that comes in any kind of a fluctuating market, please understand this very clearly, is that strictly go to the fundamentals, shift on the fundamental side completely. Usse do cheez hota hai. There are two things that are an outcome of that. It acts as a natural hedge when the market goes down, because you are sitting in fundamentally stronger companies. They may go down a little, but they will not fall as much as the market, is the broad nature of a fundamentally strong company. So you will sit on the fundamental. That is one. The recovery from the lows to the highs is very high typically if you have any fundamentally strong company in your portfolio. So both ways, to hedge your risk as well as to make sure that you are recovering fast, you need to move to completely a fundamental approach to investing. Number two, at this time, you should avoid any kind of a swing trading, primarily any kind of a trading activity if you're not an experienced investor. If you're an experienced investor and you know that you can play that whole piece, you have the risk appetite of playing that, you can do that, but volatility is very greedy. See, what happens is that we feel very greedy in volatility. When we see stocks going up for 3%, 4% in a day, that is the biggest greed of the investors, because you know that why do you need to stay invested when you can take an extra leverage position by earning maybe 4 times or maybe making it 15% in a day, right? So that is something which is a big outfall of a volatile market. And we are currently in a volatile market, which has a jump of up and down that is happening rather than a gradual up or a gradual down. That is the reason I feel that if you're a new investor, you should sit out for any trading activity. You should not participate in any trading activity. The next point, please do not go on tips in a market which is moving and where the movement is such. There's a lot of greed that is already there in the market. A lot of people will give you stories of I made 200% in this particular stock, 500% in this stock, and also this is not that time. There is always a time for these kind of stocks as well. There's always a time to festering your greed, but this is not the time. In a undisputed upward market, whatever you touch will turn into gold. In a undisputed bear market, whatever you touch will go to ashes. In a volatile market is the most undirectional market, which will make sure that somewhere or the other you don't know what is happening one way. There is no unanimity in movement of stocks in these kind of markets. So please stay away from any kind of a tips or greed. Now, no leverage to ensure that you don't have any compounding losses. 5% loss हुआ चलता है लेकिन वो 15% नहीं करना है. We don't want to have a 15% loss because there was a principal 5% loss. So this is not the time. If you have any margin, if you have any leverage positions, I think you should seriously consider winding them down so you don't have any principle of compounding loss out there. And don't go beyond your asset allocation. This is not the time to say I will overexpose myself to equity. So if I have a allocation where I decide that 80% into equity, 20% into debt, this is not the time to put that 20% on the table and invest more. But if you look at the investment strategy, right? For new clients, if you are today looking at investing, the first thing is do not invest your lump sum allocation at the current valuation. So if I have 100 rupees to invest, I will not put my whole 100 rupees in right now at this point in time, right? Now, how will you define when to put what is, for example, you go with a 3 to 4 month allocation, staggered allocation approach. This is something which will cover one more result cycle, right? So there is a lot that will get clearer in the next 3 to 4 months. There is a lot of news playing various things out there. And the best thing or the smartest thing sometimes is not to do anything. So the smart thing would be that you say that, okay, I'm putting in out of 100 rupees, say 20 rupees right now. And I'm going to wait and see what is happening out there, right? Now, if there are dips that come in, I'm just giving a number. You can decide your number, but my number is say a 5% dip, I'll put the next 20. Another 5% dip from there, I will put another 20. So I am covered up till around a 20% overall market loss. Because once that goes around, the recovery of that would be averaged out around 10%. So that is how I'll play. Not to say that the markets will go down 20%, but I'm saying that I'm preparing for a 3 to 4 month allocation strategy. 1/4 of my investments starting now for month on month for the next 3-4 months. But if the market goes up 10% out there, don't lose the plug. This is not the time to say, oh, market to chala gaya, bhag gaya abhi, to abhi I put another 50% in. Don't lose the plug. Wait for it, right? There is a time the correction is imminent, whether it is 2%, 3%, 5%. So there is a time you will get to put in your next one. But maintain this at least for 4 months. And in the 4 months, if we will again guide you and tell you what you need to do with the remaining 50 rupees that you have today. But in today and in say 3-4 months, assuming there are maybe 1 or 2 down cycles that may come, you may invest in the range of around say 20% of your wealth out there. Just remember, apart from the China worry, what did I tell you? Overall, the markets will show huge resilience to go back, and hence don't miss the opportunity. Don't think that this is the end of the day, this is the gloom day, this is the last day of the world. Nothing will happen like that. Apart from the China economy and the China performance, the overall market will show a huge amount of resilience to go back. This is a tug of war market. So either aaya, either gaya, either aaya, either gaya. It will give you that kind of impression. You will get up happy, you will get up sad. You will get up happy, you will get up sad. You will never get up very quiet, right? So that is the nature of this particular set of market. And it makes sense that instead, because we have these kind of biases of happiness and sadness and greed and fear and all of these things going on in our head, we are bound to make some kind of a mistake today or tomorrow. So go with a professionally managed portfolio. Go with a professional right now who's tracking your investments for you on a day-to-day basis. It can be us, it can be anybody else that you feel like, but it has to have a professional portfolio who is typically non-emotional, and only looking at the logic of the market rather than the emotions that club in, because you and me know we can't do much about it, but you and me know that emotions are the biggest enemy in the whole market cycle of investing, the biggest enemy. And it is undoubtedly clear that which way the market goes, emotions are going to be very high, both sides during these markets. So we have to make sure that we have to follow an unemotional way. And what is the only way you follow unemotional way is that you go to a professional and you follow the advice, rather than saying that I will interfere and I will do my bit of things in it. If you have your own portfolio, you like to manage your own portfolio, no harm. My only suggestion would be stick on to our strong buys and buys. Stick on to our strong buys and buys, please, because we are constantly looking at our IP and we are making sure that we have performance which is working in even these times. So stick on to that particular way of investing. And even in the down market, even in the markets are not down, are not going anywhere, if you have stocks in your personal portfolio that are still going up and showing fundamental strength, they are a part of strong buys and buys. Markets going down, but your stocks are going up, one stock is going up, second stock is going up, make sure you allocate a little bit more onto those stocks from the other stocks. So sometimes you may not invest new money, but you can manage your current money very well. Nothing to say that 20 rupees I invested, so I am sitting quiet on my personal portfolio. I'm talking about two approaches, model portfolio and the personal portfolio approach. In my personal portfolio approach, even if I've invested 20 rupees out of my 100 rupees, sometimes that magic of how you manage that 20 rupees can give you a lot of wealth and can safeguard everything for you. So there you have to make sure that you stay invested in the strong buys and the buys, move out of sells and strong sells, keep going back. The reason I'm telling you not to look at the returns right now is primarily because these are fundamentally strong stocks, and fundamental strength of the stock today and tomorrow will play out. There is nothing in the world can stop, and nobody has been able to stop since the advent of this whole stock market across the globe. That's fundamentally strong stocks will not give you returns. It's a question of how much returns, right? So, this is what I require from your side, and we will do the rest. Now, understanding fundamental investing, as you guys know a little bit, but let me just throw a little more light on it. What is fundamental investing? Is there a way that, and this is the forefront of our company for the last 6 years now, that is there a way that we can create higher returns by taking lower risk? So we always think about how well we can generate returns by taking as low risk as possible. And for us, this market cycle is the absolute perfect market cycle to prove this point, that how do you take and how do you still do superior returns by taking lowest possible risk in the market. How do we do that? We have these 4 parameters, as you guys know, which is the 4 dots of MarketsMojo. Quality is a 5-year fundamental strength of the company. So we look at for the 5 what is fundamental strength? Fundamental strength is the strength in the financials of the company, not the stock price. Financials of the company. So your P&L growth, your cash flows, your balance sheets, your debt, your return on equity, your return on capital employed. So we look at all of those factors on a long-term basis. And we never invest in a company which has got an average quality, which means that consistently over 5 years, this company has to be either excellent in quality or good quality company. The second factor is financial trend, which basically says the last results are declared. It should be a great result, right? So if the company over the last 5 years has been declaring great results and the last quarter results is also good, that means it is fundamentally a investable company in MarketsMojo's horizon of stocks that we look at. And then we look at valuations, and then the shorter term parameter that we look at, which has not got a very high weightage in our way of selecting, is the technicals, that we have to find the right time to get in and get out of the stock so that we can make sure that our returns are incommensurate with the way the market is going. Now, this generates a stock score. As you guys know, you guys are experienced investors, a lot of experience, I'm saying, in terms of understanding what we do. And then we have weights on these stocks, which are dynamic across for all stocks. And then these 5 factors make me very comfortable in the way that I talk to you, because I know that we have tested the stock across every possible way, right from its periodic returns, right from its periodic relative returns to the index, consistency kitna hai uska over years, drawdown kitna hai, less hona chahiye drawdown as compared to the Sensex, which means that it should go lesser than the markets, and the success rate of this stock. So when these 5 parameters are correlated with the stock score, that is when you see what you see on the side as a simple score of a 76 or 82 or 84, which goes through this whole cycle to create the concept of fundamental investing. So remember, considering this year, considering everything over the last 5 years, our strong buys have displayed a 80% success rate and has given an annualized 5-year return of close to 85%. Annualized 5-year returns, which means that close to 1 year, 2 months money getting doubled for 5 years. It's straight for 5 years. There is no backtesting data here. These are actual data since the time we started advising investors on their money. Similarly, on buys, if you see sell with a benchmark of 15%, we were better than sell, because when we gave a sell call, the stocks went down. The sell basket return was 13%. Strong basket was minus 7%. So the strength of your logic has to work both ways, not just on strong buys, but strong buys, sells, as well as the strong sells. And that is the whole concept which makes us so strong in terms of fundamental, because in fundamental investing, your success rate will come to 100%. It's a question of how much time. It's a matter of time. And that is the reason that whenever we talk to investors like yourself, we always say, be patient and have the discipline. Discipline of following and being patient, because this will come back. Fundamental investing has to come back in any market cycle. Now, what does the Mojo Professional Service do? Now you can invest in five portfolios from 1 lakh to 5 crores. So, you can have variety of portfolios, and I'll talk about these portfolios, variety of portfolios, but you can invest up to 5 crores, and you can start investing from even a small amount as 1 lakh rupees. You can invest in top stocks, which we call as Mojo stocks. These are the most strong on fundamentals that we have. There's at any given point in time, there are around 40, 50, 60 odd stocks that are there, where the fundamentals are strongest and even the technicals are supporting it today. So it's a perfect mix of what the stocks that we are looking at. We will give you real-time recommendations on all listed stocks. So we are the world's first company which covers 100% of stocks. World's first company that covers every single stock on recommendation, and these are real-time recommendations. You can also have an ability of putting in a stock that you hold currently, and we'll tell you whether to switch out and how much to switch out and what quantity of the next stock to buy. Stock of the month, we give one stock of the month, which is a strongest stock that we see for the longer run. You can also upload your current portfolio, which you may have with any broker. Aapka koi bhi broker ho, you just upload your current portfolio, and we will start advising you on your portfolio, and you can transact with your broker. Right? Remember, we are not a broker. You can transact with your broker. We're the only company in this country which is a pure advisor. We are not a broker. We are just pure advising our customers. You can make your own stock selection by using Screener, and you will obviously daily these webinars that we do 2 webinars a day, where we are always in front of our customers, be it good time, bad time, ugly time, beautiful time, or whole time, whatever it is, but we are always there. 3 pillars of MarketsMojo as a promoter that I had kept right from the beginning is trust. Investors should be able to trust us. Trusting us means that we are performing. When we are not performing, we're coming out and telling them. It's about having that transparency and always stay unbiased, which means that whether you are a 5 crore customer or a 1 lakh customer or a 50 crore customer, we are not making money in that proportion from you. So we are not an organization which will make more money from rich customers, less money from this. For us, every customer is the same. Every customer has one objective to make money. And that makes us completely unbiased towards our approach. Even our pricing approach, if you see our subscription approach, is a single amount approach. It is not dependent on what kind of money you invest in. So we stayed focused towards these 3 parameters. Now, We said that invest through a model portfolio, but how to choose a model portfolio? This is a, 3 model portfolios that are available on the site, right? 10 stocks, 12 stocks, 15 stocks, aggressive, moderate, conservative. Market cap allocation to mega and large cap is up to 100% for the aggressive portfolio. For the moderate portfolio is up to 100%. For the conservative portfolio is also up to 100%. Mid cap up to 50, 50, 50. And small and micro cap is where the difference comes, which is 40 and 30. So we have created in both aggressive and moderate portfolio that they can become conservative on its own. If the market moves towards mega and large cap, the aggressive portfolio will 100% or can 100% move into large cap. A moderate portfolio can 100% move into large cap. If the market is becoming focused towards mid and small cap, an aggressive portfolio can go up to 90% into mid and small cap. A moderate portfolio can go up to 80% in mid and small cap, right? But a conservative portfolio can only invest in large and mid cap, and it can go up to 100% in large cap, or the most aggressiveness that a conservative portfolio can show is 50% mid cap and 50% large cap. So I hope you understand the versatility, because when I say this is a big point you need to understand, is because not a single portfolio player in the country today runs this strategy of dynamic market cap allocations and having full strength to become conservative in the same portfolio and full strength to become aggressive in the same portfolio, right? So if you see classically today, aggressive portfolio is sitting on close to 40-45% large cap allocation, and the remaining is mid cap with very small cap, around 9% small cap allocation, right? So that is what it is showing today. So it is already towards a moderate approach that it is taking. It is not fully gone to conservative, but it is taking a moderate approach of investing right now. Now, if you look at our 5-year absolute returns model portfolio, the aggressive portfolio is done around 511% versus the market of 100%. The moderate has done 383% versus 105% of the market, and the conservative has done 194% versus 102%. These are your returns of every year that you've seen out here. I repeatedly show this particular slide to you, and I'm sorry if you've seen it enough number of times. But if you see right from 2016, where the market gave 6%, we gave 13%. From 2017, 35, we gave 84. 2018, market was down 3%. We gave a 20% positive return. To every year, we've beaten the market. Every year, we've beaten the market. I have no doubt that even this year, we will beat the market. Now, we already started. We had a 1-month underperformance, but let's just review that. The 1-month underperformance has gone. If you see the BSE movement of 3%, we are already at 8%. So we've recovered that 1-month this thing, but we are yet to recover the 3-month paradigm, where the market is up around 11% and we are up around 4.8%. And 6 months, anyways, the market is up 20%. We are up around 56 odd percent. So if you see, we recover very fast. Now, some of you have started a model portfolio, you would have gotten it at various times, but the performance has already started coming in. And when the performance comes in, it comes in multiples because of the whole fundamental approaching sense. I'm not going to go down across all these tables which are there, and maybe you can listen to the recording of this later on. If you are a stock investor, if you have model portfolio, you also want to do stock investing, then if you see today the diversification that is there in the Mojo stocks, if you see 13% is from IT software, iron and steel is 8%, cement is 7%, chemicals is 7%, auto ancillary. So there is a very broad framework of allocation across the industry that the Mojo stocks is showing as of right now. If you were to look at the results of these industries where we are parked, right? This is the last quarter results, consolidated results of every single company that was there in this sector. Now, if you look at in the IT software, 100% of the large caps declared positive results. 75% of the mid cap results, companies' results were positive, and there were no small cap out there. So 83% is the total. Now, if you look at auto ancillary, 100% large cap and 96% small cap. Overall, 97% of the companies declared positive results. Similarly, plastic products, healthcare services. So some of the stocks that are there here, they are not fluke stocks. They are fundamental stocks, because there's also a fundamental story in the sectors that are going up. There's a big fundamental story in the sectors that are going up. You clearly see finance and NBFC, where there is a fundamental story which is not going up, which is 29% large cap stocks declared positive results, which is 50% for mid cap, which is 57% from the small cap. This whole data that I'm showing you is from the results section. You guys can all go to the results section and check the results section across any industry out there, and it will show you which all are the companies which are under these set of companies. Now, if you look at the best performing BSE 500 stocks in FY21, right? You have close to six stocks in which we were there in the which were there in Mojo Strong Buy list or Mojo Stocks list. 6 out of this 12 we were there, right? Adani, as you guys know, is an average quality company in our system, so where we don't invest in Adani. So 3 companies, if you go out, take it out. If you look at the other set of companies, there is 70% of the top performing companies were Mojo stocks. Guys, it's a big thing. The 70% of the top performing companies last year were Mojo stock companies. And hence, it tells you that there is a huge correlation of what returns fundamentally strong companies can give you. Similarly, if you look at the negative companies, none of these companies which were within BSE 500, these were the companies that gave the worst results. Not a single company was even a buy in our system. They were all buy, sells and strong sells. So both ways, when you look at that data point that I showed you of CAGR and success rate, and when you look at this, you will see what I'm trying to gather out here and show you in terms of the strength of the way that fundamental investing IP can work. Similarly, if you see, we have, I think, around 75, 76 odd stocks in the Mojo stock list. 63 out of those 76 stocks are outperforming. 63 in these markets, in the volatile markets that we are. And this is not just large cap stocks, it's large, mid, small, micro cap. So 63 out of 76 stocks are outperforming. These are top stocks. These are the most fundamentally strong stocks that you get out there. And there are around 13 out of 76 stocks which are live today are underperforming. And most of these stocks, I've listed all these stocks here, most of these stocks are under 2 to 3 months in the system. So 10 days, 1 month, 9 days, 1 month, 19 days, 4 months, there's one exception out here, but 3 months, 1 month. So there are only 13 stocks which are today looking at negative out of the 76 Mojo stocks today. And that is the inherent strength. So I have covered both spectrums of your investment strategy, broader strategy, starting with model portfolio, and how do you need to look at your stock selection out there. So I hope you've now got a little bit of a thread and confidence in terms of how to look at the next 1 quarter, because this is not the time that we will weave a story of the next 10 years. The story of the next 10 years is clear. People who are investing long-term don't need to worry about this. People who are trying to enter with new money at this point in time, they need to go and follow this particular approach. So with that, it's a last call. The offer will end soon. So if you guys want to subscribe multiple times for 19,999, please do so. This opportunity, once it goes, we'll not be able to go back to this pricing. These links are not available on the site. It is only available on the Zoom link that Adrian will put in out there. With that, let me open the dais for Q&A.
As requested, I have dropped in the links for the offers. We start with the Q&A. There's a couple of questions on China. I'll just concise them and take 2 questions out here. One question being from Sridhar. Yesterday, Taiwan said that they are preparing for a war with China. What would be its impact over here?
See, I don't think so there is any war impact out here right now, because I don't think so there's anybody who's got a capacity of getting into a war with anybody. I think the only thing that can happen is kind of a cold war or spurt attacks. So I don't think so. And for me, I heard this particular news. For me, it is of not much of a relevance at this point in time. I don't think so. It is a path-breaking news. It's one of those things of trying to create uncertainty, but it's not something that we should be worried about.
Okay. Second question being from Mr. Rajinder Singh. Hello, Mr. Mohit. You said that China is a factor which is worrying. Can we now believe that they can be a correction? They can be on 30% kind of a correction going forward?
No, as I said, I don't see a 30% correction. Maybe you can see it. I don't see it. I told you that China is a problem. If that problem erupts, then you're right. Then I don't think so. I'm sitting in a position to, and I don't think so anybody across the globe will let that happen. But nobody is sitting in that position to today evaluate that impact. But if you ask me what is the more realistic thing, because China is sometimes too big to fail. It's not, it's a country. It's something that it's, and if you see the history of this country, they have always managed themselves very well. The only thing is that, the way they'll manage and the time and the in between time, what news will come out is the only way. But I for no reason, not even, 0.01% believe that China as an economy will fail. It will, typically there are headwinds out there. There is a lack of transparency and opaqueness, but they're very well at managing themselves out. So that is going to happen. According to me, this is a spurted economy where it's this side spurt and then this side spurt and then this side spurt. So that is the thing that will disturb us in terms of having a clear view. But I frankly, and I'm happy to be proven wrong on this one, but I frankly feel that it is not looking like a 30% down.
Question from Mr. Harmeet. Thanks, Mohit and team. I'm 50 and still learning. I'm now following the model portfolio approach. Just wanted to ask if I can keep buying each month as SIP in the stocks mentioned in my ideal portfolio.
Yeah, so you can see the model portfolio has two lovely features in it. One is that you can add investment any point in time. So you don't need to be like adding it on 5th of every month or 6th of every month. So it has a add investment and a reduce investment amount. So let's assume I start a portfolio of say 5 lakh rupees and I want to invest 20,000 rupees this month, right? So I can say add investment to my portfolio and I add 20,000. It will tell you these are the 3 stocks you need to buy, the quantity, just call up your broker and buy those. And it auto updates out there. So you can add any number of times. You can add 4 times a month or 30 times a month also, trading days. And you can remove also at any given point in time. So it gives you that it's a beautiful tool that it is not that once a month or something. You can invest 5 times a month also, and you can remove 5 times a month also. So you can do all of that in the model portfolio.
A couple of questions on the offer links. Mr. Jay has a question stating that I already have a membership till May 2022. Will adding the 19,999 offer extend my membership till May 2024?
That's right. It will extend if you buy it once. If you buy it twice, then it will extend till May 2026 as well. So make sure you do a larger extension out here. The reason I'm saying that is because you are hedging yourself to any price increase. We've done 3 price increases in the last 3 months. And with technical products coming in, our price will further go up for 10,000 rupees a year. So if you want to hedge yourself for these kind of price increases, maybe you take a longish kind of a membership. Yes. So the more you keep buying that 2-year plug, it will keep adding on to your pack.
Also from Mr. Sridhar, I have dropped in the links as well. He was asking for the 2-year extension link. Going to the next question from Mr. Ram. For new Mojo subscribers or investors, how do we start investing for long term at this moment when India markets have topped, but NASDAQ is showing signs of bear run?
Yeah, so as I said that is exactly the whole way in which I did the presentation. If you're a new investor and you just subscribe or you're subscribing, or even if you're an old investor of MarketsMojo, I would suggest that if you have 1 lakh, I'm taking 1 lakh as an example. If you have 1 lakh to invest, start with a 20,000 today in the model portfolio. Choose a model portfolio. If you are not sure of which model portfolio to choose in between aggressive, moderate, and conservative, I would suggest that you start with a conservative, moderate model portfolio, because it can become very conservative. It can become reasonably aggressive, right? So start with a moderate portfolio, start with 20% of your allocation there, and then wait for the markets to, correct a little, and then put in the next 20%. That's the whole approach that I was suggesting, a 3 to 4 months staggered investing approach. bear run signals are not there in the in the US economy as well. It is not something that you're seeing as a big bear run signal that is coming in out there. These, as I said, are very mixed signals coming from various directions, because see, the fear is that everybody is today fearing the fear of height. Itna market kaise ja sakta hai? How is it that the market, and we also feel like that, right? 100% in a year, what is happening? Right. So, but now if your markets were up 25-30%, you would say reasonable. Itna to hota hi hai. 20-25% Indian markets can grow in a year. That is something that has happened. We've seen it 20 times. I think it's the fear of valuation, and that's why I feel that the valuations are overridden. For us to correct, or for evaluations to correct, there are two things that I have to. Either of the two things. Valuation is a parameter of price and earnings, right? Our dependency on fundamental growth is that earnings has to come. So in next quarter, the earning has to come. Otherwise, the price has to correct, because this is not sustainable. So now the battle is in between earnings and price. But still, if you were to see, even if the earnings were to come in and decent earnings were to come in, I think the price is still high. So that correction of, as I said, that 5-10% correction may come in, because even on a forward P, if you see 25 versus say our average of long-term average of 19-20, it is not, we are 20% way off from there. And markets will typically fluctuate. It's not that average every year has to be the same. So sometimes 21-22 chalta rahega long term, then 18-19 chalta rahega. So all of that will keep happening. But the real thing, which is the driver of all of this, is fundamental earnings growth. And that is something that repeatedly, when we see corporate India declare results, that is not disappointing us. What does that tell you? The reason that is not disappointing you is that people in the last 3-4 quarters have been able to manage their profit efficiencies very well, because top line growth nahi ho raha tha, sales growth nahi ho raha tha. So agar sales growth zyada nahi hota hai because the market was, economy was shut down, they were managing their cost structures very well. They're paying off their debts, managing their cost structures very well. So they were able to maintain that profit margin. Now, when you are able to get that cost consciousness in, and when the markets opened up and you're back to your sales numbers, right? That profit efficiency number, which is a percentage that you've been able to manage very well over the last difficult time of 2 years, that will give you a higher chunk of profit. So according to me, earnings will come in sooner or later. So, start with with an assumption that there can be a downslide. Also live with an assumption that the downslide can be very fluctuating, up and down, up and down. And that is where a stock approach will always work. No long-term, approach can work out there till the time that you are only holding a fundamental stock portfolio.
Question from Mr. Bhavesh. Do MarketsMojo also suggest US stocks to invest in our portfolio?
We do suggest. We have a different company by the name of InfinHub, and there is a big offer that is going on out there. There we don't just suggest US stocks, we suggest stocks of 20 markets. So today we advise 60% of the global markets, including India. So InfinHub is a platform which is known as International Financial Hub. The full form is International Financial Hub, which has 21 markets today. And across 21 markets, you can check any stock, and you can also, across 6 markets, including US and Canada, across 6 markets, you can invest in the model portfolios as well. And so that, I think we had priced it at around $799 a year. We are currently giving it out at $399 a year with 100 days free as an initial offer, because this company, just went live 6 months back. So that offer, I think, Adrian, you can put it up. You can subscribe to that. We are also plugging in 2-3 brokers in InfinHub, so that you can also have a seamless transaction on international markets, on global markets. So we are working very fast to try and get 3-4 broking platforms, guys like Small Case in the international area, who will give you a API link so that you can transact straight away from our site onto their site. So we are bringing in that facility as well.
As per your request, I have brought in the link as well. Question from Mr. Robert. Mr. Mohit, the staggered investment approach that you're recommending for the next 4 to 5 months for stock, would you also advise to have the same strategy for mutual funds as well?
Yeah, so there is not much of a difference. I would say have the same strategy for mutual fund as well. It's equity investing. Both are the same. So I would suggest have the same thing. I'm not a big subscriber of SIPs. I am not. Typically, it averages out everything. I'm a subscriber of a concentrated approach. My preference to model portfolio is always very high than a mutual fund because of the whole sheer ability to concentrate and give you, better wealth management approach rather than 50 stocks, which a mutual fund would typically invest in. But if you are a mutual fund investor, you can follow the same approach. Answer is yes.
A question from Mr. Dr. Jay. Hi, sir. This is just a doubt. I'm a subscriber of InfinHub. Can I wait to invest in the US stock until you tie up with a broker, or can I directly go ahead and start?
No. You can go ahead and start with any broker. We are broker agnostic. This is a facility we are giving in case you don't have a broker. Then we are giving the facility to opening. If you have a broker, please go ahead and invest through the broker. This is not. There is no compulsion out there. We are just giving you 3-4 brokers because a lot of investors who are interested in global markets, they ask us that how do I start a broking account? Who do I deal with? This is for those guys. We're saying that okay, we will choose some brokers for you and you can deal with them. We have no economic interest in this with the brokers, right? So we don't get anything, we don't give anything to them. So we just make sure that there is a service facility that we are providing you. If you have a broker, please go ahead with your own broker.
A question from Mr. Abdul. I am a new subscriber and I have around 10 lakhs to invest. Can you please help me or suggest me an approach that to be followed from portfolio, Mojo stock, or stock of the month?
If you have 10 lakhs and you want to invest, I would say it is an apt amount for you to start investing in the model portfolio. Maybe you can start with 2 lakh. As I said, start with a moderate portfolio, invest 2 lakhs, and then wait for the next signal. The next signal would be if the markets are correcting 5%, then you would typically say that, can I put in the next, say 2 lakhs in it? So stagger it out, or either you return stagger it or time stagger it. See, there are two ways to staggering it. One is that you're saying that I will return, and I'm not an astrologer to tell you which approach is the right approach. Like today, I would much rather stagger on the market returns than on time returns. When you purely stagger your money on time return, that is known as a SIP approach, irrespective of where the market is. I will invest on a specific date, right? That is a SIP approach, which works very well. It works very well for model portfolios. Doesn't work well for mutual funds because mutual funds are already diversified so much. And then you diversify your return by investing every month. You're not catching any time frame out there. The second approach is to stagger basis the returns that you're generating. So that is the approach that I'm saying, that you invest 2 lakhs, then you wait, let the market level up a little. And when you put in the next 2 lakhs, even 3-4% is fine. You're not putting your full 10 lakhs. So stagger it into 5 steps and then you keep investing at the bottom.
There's a question from existing investors. Is it the right time to stop putting more money?
Sorry?
The question is for existing investors. Is this the right time to stop putting more money?
I would say wait for a little while. I would say wait for the result cycle to come in, because I'm very keen on looking at the earnings in terms of how the earnings of corporate India shape up. I would say that you can wait for some more time. See, if you have a 10-year horizon, then I would say you should not even attend this webinar, because my horizon is that. Like if you ask me, Mohit, when was the last time you invested? 2 weeks back. When is the next investment you're doing? I think I'm doing an investment on Monday. So I am not bothered because I don't even look at my portfolio, because wo chal raha hai, that is going to compound. Worst situation is what? Market itself is compounded at 14-15%. Right? Which means that 4 years money is double. That is the worst situation. Now MarketsMojo has compounded at 46%. So I am invested only in MarketsMojo portfolios. My viewpoint is, see, I have seen the markets for a long time. I have worked very hard on maturing my mind to not get deviated on day-to-day events and all that stuff. I have firm belief in the Indian markets, and I have firm belief in MarketsMojo's ability to generate alpha out there. So the way I invest is that irrespective, my investment is always driven by when can I have the money, because wo nahi to kharcha ho jayega, I would put in there. Even, trust me, sometimes I have 3-4 lakh lying, I will just put in there. If I have even thousands lying, I put it there. So I just use it as a piggy bank, which I'm not going to open, because I know that is the only way you can somewhere reach to 100-200 crore, even if your investments are abysmally low. Because when you're not touching something for 15-20 years, it doesn't give you any headaches, right? You're constantly this thing, your emotions are not playing out for you, so everything becomes fine. I think closing the eye sometimes and following a disciplined approach is the easiest approach to follow, which I follow. But if you have to know yourself, you can't be me, I can't be you, right? We can't be each other. So if you say that yaar हाँ अभी मेरे को थोड़ा overpriced लग रहा है, तो then you stay out for a little while, don't invest right now. For that set of investor, I would say that then you typically look at the next earning cycle and let's then invest during that particular cycle.
Okay. A question from Sondaram. I want to be an HNI investor. What is the criteria for that, as I want to be a high network investor?
Sandra, we are launching an HNI service very soon. It's just about 2 weeks away from where we are today. So if you want to invest in the HNI platform, I am doing a proper launch of the HNI service on this Thursday. We're doing a management launch for everybody, for all of you guys, where we'll disclose what is the requirement and what are the services that we will offer out there. And then we will call for applications of people who are willing to participate in that. We've already got around 500 applications. We are only going to take 500 to 1,000 clients. So 500 clients have already written to us that they want to participate. So just wait till Thursday, and when we'll announce this on Thursday, we'll give a window to everybody to put in, their requirements if they fit into that. So just give us another 2 days. It's Tuesday. It's already Tuesday today. On Thursday, we'll be launching it.
A doubt from Mr. Sridhar. Hi Mohit. Currently, I have a plan with mutual fund which is valid for the next 2 years. Now, let's say if I extend for 2 years without mutual fund, will I still get that mutual fund plan which is already existing for 2 years, or will I lose that once I extend?
No, so you will lose that once you extend, but I'm sure at that point in time, what we may do is come out with a marginal amount for you to even plug in the mutual fund as well. So don't worry about that.
Okay. Question from Kedar. Is it a good strategy to sell off my entire personal portfolio and put it in a model portfolio?
I don't know, Kedar, what your portfolio returns are. I don't know how effectively you're managing it. It's a blind answer for me. But I would say that a disciplined approach for investors who either have not been able to generate those kind of returns, or maybe they don't have the time to track this on a day-to-day basis, on a real-time basis. A disciplined approach for those investors is always to get out of their personal portfolios and invest in model portfolio. I always suggest that approach, because that then is in my control. I can manage and advise you on a day-to-day basis. So that would always be approach. But I'm saying, as I said, it's a blind answer I'm giving you because I don't know your portfolio. I don't know your profile. I don't know your past performance of the portfolio as well.
Okay. Question from Dr. Jain. Sir, I'm planning to invest in India and US portfolio with a ratio of 50-50. Is it a good strategy, or should I allocate more towards India, as India is a growing economy?
I would say, I would say a 50-50 or a 60-40 is a good strategy towards India.
Just a thank you message from Mr. Sondram. Thank you, sir. Recently invested 2 lakhs in model portfolio, and I'm impressed with the returns that you're providing. Thank you so much for that.
Thank you.
A question from Premal Thakkar. So do we have an option of removal from our existing portfolio? Let's say my portfolio value is 50 lakhs and I want to withdraw 10 lakhs and I do not want to use the switcher option.
Yeah, we have within your portfolio section, we have also introduced a add cash, remove cash facility. So I can show you that right now. Just give me a second. So now, as you guys know, that if I were to even go down to the model portfolio, you know that there is an add investment and reduce investment option out here, right? Similarly, if you were to go to your personal portfolios, within your personal portfolios, which are not model portfolios, which you can manage through anybody else, you also have a add cash and remove cash here. So if you want to remove out of this portfolio, say 10 lakh rupees or 1 lakh rupees or whatever it is, you can just say reduce cash. You just put in your amount and it will tell you how to remove that money from there. So that feature is available.
There are two questions, one appreciation message and a question from Mr. Jeet. Does the personal portfolio advisory include in the pack that you're telling, that is 19,999?
Yes, personal portfolio, the portfolio optimization service is absolutely included in the pack. Yes.
So following, he says that I love the Mojo Markets. Thank you so much for your service. You guys are awesome.
Thank you so much. Thank you so much for your appreciation.
Question from Ms. Johnson. What measures can SEBI take to dampen volatility?
No, they're not taking any measures to dampen volatility. I think they are behaving exceptionally well. According to me, I salute this regulator at this point in time, because they have anticipated this whole growth of retail investors coming in, and they're making retail investors' life difficult to trade unless they have the money. So it is the easiest thing today. You go in the market, everybody will suggest you FNO strategies. Everybody will say, we'll give you this much leverage, we'll give you that much leverage. And you guys are, there are so many, just imagine 10 lakh investors who've never invested on a monthly basis, go in and open their accounts with brokers. And they get all this plethora of data, and they get a leverage, and they say that, okay, 100 rupees to main dalunga, to main 200 ka kar lunga invest, or 300 ka kar lunga invest, and all that stuff, So that, and when the market goes down and when that gets corrected, so SEBI has been very, very, I would say, clear about its objective of safeguarding the interest of the retail investors, that you need to have so much money to take any kind of a margin. You need to have money even to sell your stocks. So it is tightened up the whole transparency, tightened up the whole, risk of a retail investor. And that, according to me, will curtail volatility in a big way, because volatility is never fundamental driven. It's either news driven, it's either event driven, or it's either position driven, of what kind of positions the traders are sitting on. So it is, apart from the three things, which is news, events, and technical positions, right? The volatility is actually becomes a fundamental volatility, not like any of these out-driven external volatility. And I think I salute SEBI for their role in terms of safeguarding the retail investors, because हमारा country का problem यही रहा है. Our problem of the country is that people know that markets perform. People know that it gives you 14-15%, but still investors don't come in, because when the investors come in, A, they don't know how to invest, and B, we give them platforms with margins in it, and C, there are these, there are no research platforms available to guide them. So they take random calls, and then they'll end up losing, because we know that I have ran a broking house. I can tell you over 98 to 99% of the investors always lost money in technicals, always lost money in trading, but still the same set of customers will come out there. So it has, where there is a chance of completely killing the wealth of an investor, SEBI has played a brilliant role, if you ask me, and I think it will control volatility going a long way going forward.
A question by BCJ Funcom on Infinab. When would the amount reduce from $10,000 to a minimum, the investment amount?
We're still working on it. Give us some time. As I said, that we are currently absorbed in the HNI product to create that, because we have a deadline to launch it to you guys. Our second deadline is, towards Diwali, we are launching the series of technical products. And that is the reason I keep telling you, increase your packages, because otherwise that package price will go up and become double from where it is. 19,999 will become close to around 40,000 as soon as we launch the technical product. So we are just working on these two products right now. We will have this issue addressed very soon.
Question by Ms. Kashishwar, I'm dropping the link for the 1-year professional and plus mutual fund over here in the chat box. Moving on to the question from Mr. Bhavesh Modi. Do you feel the threat to Indian equity market as digital currency is gaining attraction day by day?
No, I don't think so as yet. I think it's too way off right now. I'm not seeing the change of thread from a digital currency to Indian markets. I think it's something which is too opaque. I would say it is China's China. I would say the whole Bitcoin thing is a China's within China, and that kind of a opaque element right now. So I don't know which way it will go. So, but anything that goes up 2000% in a day and comes down 500 or 1000% in a day, you know what it is. So, and that is one of the things that even the regulators are banning it. That till the time we don't understand the impact of this, see, it is a global product. It's a global contract. You don't know what all things can happen out there. So it is for a normal investor to understand. I've taken close to maybe 10-15 years to talk to investors, to tell them about investing, where I've created a tool which is the best tool today for them to just follow the advice of a strong buy. They still don't do it. So Bitcoin or this digital currency is a very different way of thing. For retail investors to understand that, I'm telling you, I don't understand it. And that's the reason that we don't recommend, because there is no point of something just to, I mean, today if I were to say buy this particular digital currency and it goes up 200%, you will applaud. Arey, wow, what choice. No, it doesn't give us confidence. It is, ultimately we have to look at God and say what we're doing today is something in the interest of the investors. Truly speaking, we know what we're talking, or we're just saying it. So we have no view on it, but I would say it's very opaque right now. It is very new right now. There's enough opportunities to make money. Enough opportunities, right? We'll make money the right way and the way that we understand. We don't understand this at this point in time.
Okay. Question from an anonymous attendee. I have 80 lakhs to invest as of now. Do you invest that? What do you suggest? Do I invest in model portfolio or Mojo stocks, or balance it with mutual funds and model portfolio?
See, if it all depends on what kind of an investor you are, right? So if you are typically an investor who has 5 to 10 years and you say that this is a money I want to invest, I would not suggest a mutual fund route. I would suggest a model portfolio route, right? So that is my first answer to you in terms of selection in between model portfolio and mutual fund. Now, the second thing is that there are some people who want to have personal portfolios. They want to have personal portfolios. They like to learn from buying and selling stocks and all. If you are one of those investors, then I would say put around 60 to 70%. So you can put around 50 lakhs to 60 lakhs in a model portfolio, and the remaining with around 10, 15, 20 lakhs, you can build up your Mojo stocks portfolio. You can do that as well. If you are an investor who says that, yeah, I am, मेरे को 10-12 concentrated stocks, great stocks across my 80 lakhs, I want somebody to manage it for you, then put the whole amount into the model portfolio. So there is nothing right or wrong here. It all depends on what kind of an investment strategy you want to adapt. Like I am 100% invested in only model portfolios. I am 100% invested in only model portfolios because of regulatory requirements. I don't buy and sell stocks directly because I know what kind of Mojo stocks are coming up. So I can adversely, impact my wealth when a Mojo stocks comes in because of the sheer volume of investors that are following it. So we have an insider trading policy where we invest in the same model portfolio that you invest in. We get the same instructions that you get in, not a minute earlier, not a minute late. And we don't invest in direct stocks at all because that is violation of law.
A question from AV Kiran. If I have to invest in model portfolio, when can we have an option to invest around 25,000 instead of 1 lakh rupees?
See, 25,000 se model portfolio banta nahi hai. The reason we've kept it as 1 lakh is that 1 lakh is a bare minimum for us to buy 10, 15 stocks, right? You cannot make a portfolio with that. You'll have to buy 1 stock, 2 stocks and odd lots and all of this stuff. So that's the reason that we've kept it. It's not to say that only a 1 lakh customer can invest. It's an ideal size that we've seen, because certain times you need to buy 10 stock and the stock is at 2,000 rupees. So, that is, it spoils the whole allocation. It doesn't let us buy some high price stocks because 25,000 amount doesn't allow us, and we don't want to compromise on the kind of stocks we pick up. So that is the reason. So 1 lakh, I don't think so will go down. 5 crores can go up, which is what we'll be thinking in terms of the upper side. But 1 lakh to define, it's basically not a workable portfolio for me. If it was workable, why would I not give you even a 5,000 rupees portfolio? It is not workable because we don't want to compromise our 10 stocks because of the value that you need to put in there.
Okay. Question from Mr. Sid. Mr. Mohit, is MarketsMojo planning a tie-up with Indian-based trading platforms?
Yes, we are planning to give you the service convenience of a broking house, but we are very picky and choosy. Either we will create our own, where we will not charge our customers. That is our first option. Or else we will tie up with somebody, but that somebody cannot charge our customers. My view is very simple, that broking should be zero. Because the price is not how much you pay on transaction. आप लोग सब्जी तरकारी नहीं खरीद रहे हो. I think the price is of the advice. Whether you make money is what matters. Whether you buy it for 15 rupees a lot, or 20 rupees a lot, or 30 paisa on brokerage, I think the brokerage cost has to come down to zero. It will come down to zero. You will see it. It is the price of the advisory, and that is the reason we are building our brand in a way that it's purely an advisory brand. So yes, the answer is yes. We will give that convenience either through a partner who gives that facility of zero to our clients, or else we will open our own broking, where we are giving just a service to our customers with no charge.
Taking the final question out here from Mr. Premal Thakkar. Mohit Bhai, please let us know what is the CGAR returns if invested in USA market as per your backtesting data.
Yeah, we can. I can show you the CAGR returns. It's there on Infinab. Let me just show it to you. I'll show it to you right away. Yeah, this is our. If you see our 15th, we have not taken this off. This is our 15th August offer still going on. We haven't taken it off. So that is the reason I keep telling you that ye chale jayega. We are taking it off now. But yeah, so let's come to US. Now, if you say US and you say start a model portfolio, we have 5 model portfolios in US. Yeah. You have a NASDAQ active portfolio. So the NASDAQ active portfolio has done a 5-year absolute of 270% versus benchmark of 201%. The US multi-cap strategy, where the benchmark has done 98%, we've done around 232% in 5 years. US diversified, where the benchmark has done 98%, we have done 192%. And US select, where the benchmark has done 98%, we've done 161%. So it is there. You can choose any. Let me choose, say, a multi-cap. And I will put in an amount here, say $20,000, and generate your portfolio. So it will generate my portfolio across US multi-caps, 15 stocks, 12 sectors, 22% towards medical equipment supplies, 100% portfolio excellent quality and good quality. 35% has positive trend, 95%, 93% is, so you see Align Technology, ARC Best, BioRed, Blackstone, Conti Resources. So this is the portfolio as of right now. I say I've read it, you save and continue, and your portfolio is done. The same way that we have it in India. So you can see all the model portfolio returns for various countries out there. One of the most amazing things is, if you don't believe, but I will show you, which is my favorite market, because agar wahan pe mil jaye kuch, look at the Sri Lankan market. Right? Amazing, huh? Start a model portfolio, Sri Lanka, generate new. Okay, sorry, Sri Lanka, yeah, Sri Lanka. Look at the returns. Huh? There's a lot of investors are asking for this. 5-year strategy return, benchmark return is 44%. Our return is 473%. 44% versus 473. India is also not given this return. Diversified, Lanka diversified, 44 versus 281%. And Lanka select, which is just 10 stocks. Yeah. Benchmark has given 44%. Our return has been 406%. So it is amazing work that we're doing on the across the world on the stocks and portfolio advisory. Right. So with that, I would request Adrian to put in the offers once again. Make sure that InfinHub or MarketsMojo at 19,999 is a steal right now. This will close, renew as much as you can. You are hedging yourself on the price increase as well as the technical product price that is coming in. With that note, I'm doing a power series in the evening or a Q&A series. If you guys want to participate again, please participate at 7 o'clock. Thank you so much.
Thank you, sir. I've dropped the offer links in the chat box. I thank each and every investor out here for attending this event. We have an upcoming webinar today, as Mohit sir mentioned, at 7 p.m., where Mohit sir will be helping you in the areas to improve by investing in MarketsMojo, and also to how to invest in Mojo stocks. Looking forward on everyone seeing that. Thank you and have a great day. Bye.